Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, March the 17th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from economic to geopolitical and how that impacts my market analysis. Well, I do that same thing in these daily market commentaries, but I layer on some different option strategies that I implement into my portfolio and after coming up with those assumptions based on the economic data and the geopolitical market analysis. All right, so without further ado, let's talk about the economic data, how we see that impacting the overall markets. Well, remember, we've had this whole coronavirus thing going on, and our economic data is, in the past. So this is a relatively new and evolving situation that we have. So we can't put a whole lot of credence in these economic data points, although we are starting to see some of these data points reflect some of that coronavirus stuff that was going on, or COVID-19. All right, so let's talk about the economic data across the pond. We got the German economic sentiment coming in at 49.5, a negative 49.5. That's lower than the expected 29.7. Again, some of these expectations of the analysis were not really revised very well. We're seeing a lot of these come in much worse than expected, but that's kind of expected, right? With this whole coronavirus thing popping up on us very quickly. So the rest of the European region for the economic sentiment was also negative 49.5, expected to be negative 23.1. Now moving back over here to the United States, we got core retail sales. Now this is stripping out autos, and it came in at negative 0.4%, expected to be a positive 0.1%. They did revise the previous number up from 0.3% to 0.6%, not making up for that miss on the headline number. And those headline numbers are a little bit more important really than even the revisions, because it's starting to reflect what we've talked about, this whole pandemic that's been going on. Now, retail sales, adding back in autos, negative 0.5%, expected to be a positive 0.2%. So heading into the summer, we would expect to see some of those auto sales start to increase. I think that autos are actually going to start seeing a little bit better sales because of this whole pandemic that's going on. I don't think that people are going to fly a whole lot. Something with that, people are saying that for the airlines, this is worse than what we saw with 9/11. And, that's probably a very good case, because we are heading into spring break, people canceling their flights, amusement parks or travel destinations are shutting down. Yesterday, Colorado shut down the ski resorts. So a lot of this is causing a massive slowdown across the board. Having said that, I think people are going to want to keep their distance, but still get out a little bit. Maybe travel, when we start coming out of this, start traveling, but via the car. So we could start seeing some of the autos have a little bit better sales going forward as people are starting to put money into that. We got industrial production coming in at 0.6%, expected to be 0.4%. They did revise the previous month's number down slightly. Capacity utilization coming in line with expectations at 77%. And business inventories in line with expectations with a drawdown of 0.1% or a negative 0.1%. So that means they're moving inventories. That's pretty good, considering what we've seen. A lot of businesses are moving inventory, especially if you're looking into the Costco's and the Kroger's and things of that nature. Those guys are doing very well. As a matter of fact, yesterday across the board, we were seeing markets in negative territory. The Dow having its biggest single point loss ever, close to 3,000 points. And what was up on the day? Kroger. So Kroger is going to do very well. So when there's blood in the water, there's always something out there that you can look for that might be able to do well. The National Association of Home Builders Housing Market Index coming in at 72, slightly lower than the expected 74. Now, I have a friend that is in the mortgage business, And he's seeing people want to hold off on buying a home right now. And I've talked about this. Interest rates are absolutely historical lows here. We've got the 10-year and the 30-year basically below 1%. But people are still holding off. They think they're going to go lower. You guys, interest rates for that long term, even if they go down by another 25 basis points or something like that, which would be back at those very lows we saw, you're just not going to see that really show up so much in your monthly mortgage payment. All right. So at these levels, it is absolutely the time to refinance, or if you are looking to buy a home and aren't concerned about losing jobs and things of that nature, that it is definitely a time to go out there, get that house you've been looking for. And definitely, despite the fact that if you're worried about a slowdown, you should be looking at refinancing for sure, because that will overall lower your payment before things get bad. If you lost your job, there's no way you're going to be able to refinance. So now is the time to try and do that for sure. All right, so let's get on with the overall markets. We've got crude oil coming off just a little bit, pretty much unchanged, but we are in that 20 handle, settled in that 20 handle yesterday, and are still in the 20s. There is not going to be a whole lot of demand with all of the restaurants, everything shutting down. People are self-quarantining and staying at home, so not a lot of travel. That means there is not a lot of demand. If the manufacturers are shutting down as well, that is part of the distillates, right? We're not going to see polypropylene being produced. Probably not going to see a whole lot of paints being produced because those manufacturers are shut down. They might start seeing sales and seeing inventory move off the shelf because people are at home. A buddy of mine showed a picture of, well, what's he doing while self-quarantining with him and his kids? They're painting the house, the entire house. So they are buying product, and that's still stimulating the economy a little bit. There's going to be a lot of home improvement products. My wife is in the window dressers segment of the economy, and she thinks that they're starting to see the pickup because people are sitting around looking at their house thinking, I've got to change this. So there are sectors that are going to do okay, you guys. All right, we've got the gold futures moving up higher by about 42% or $42. Sorry, that's only about 2.8%, as you can see right there on the chart. We came down yesterday and blasted below that 200-day simple moving average, and we are still, though, right around that point of control. So I think that 200-day moving average will act as support and resistance, but keep in mind, most people are probably going to talk about that being a support and resistance, but because it's lined up with the point of control right now, you guys, it is going to be a little bit more fluid in and around that area, okay? Because the point of control is a magnet, and that is the 200-day moving average is also considered to be a support and resistance. So back above 1,500 after testing that yesterday, and today we are above that. It is a psychological level that just so happens to line up with my point of control there. All right, bonds off by about 1.5 right now. Again, I've talked about this, this is the 10-year. I do that every time. Maybe I should do the 10-year after the bonds. But anyway, bonds and 10 years are selling off, which means those interest rates are climbing. So that's why I'm talking about this. This is a very important time. We are seeing these interest rates start to rise a little bit. And in the bonds, as you can see, down over 4 points, almost 5 points on the day, down over 2%. Again, that means your interest rates are starting to go higher. And I've talked about this. Those people should not be sitting on the sidelines if you're thinking about refinancing. If you have an adjustable rate and it's based on prime, which is what the Fed fund futures are based on, or the prime is based on the Fed fund futures is what I should say, then those rates are likely to stay low for a considerable period of time. So you're going to have to weigh that whether or not you think it's good time to roll over, which I would expect to roll over into the 30-year on a fixed rate. So you don't have those fluctuations in your payment scale there, and it probably would be a good time to look into doing something like that. I'm not an advisor, so please do not take my information as investment advice. You should talk to your advisor or your mortgage person before you start really getting involved in that. All right, VIX 75, but it is well off that 85 spike we saw today. I have this on a really long duration because I was laughing. I tweeted out earlier today. Remember when we got into the 20s and that seemed like it was really high implied volatility? Well, we can look at this. The last time we saw this spike was in 2009. So anytime up into the 80s, that is a massive spike. It's actually some of the highest levels ever recorded in the VIX, which was started in 1990. So you got to take that into account as well. So the massive spike here is at historical highs as well. Then we go over to the Dow Jones Industrial Average. We can see we broke below 2,000. Now those guys probably started looking at those 2,000 hats. We are off of that by about 600 points now. So another 1,000-point swing in the Dow again today, from the yesterday to the low. And now we're starting to push back up. As a matter of fact, I think we were limit up as well. So the market having these massive swings. Right now, you guys, though, this type of doji does not really give us a whole lot of hope for a bottom. It feels more like a continuation pattern. And I've been talking about this. I'm doing another webinar on shorter term, how you trade with this volatility, and we are talking about selling into these rips because that is the opportunity right now. We are in a bear market, which I don't have my Bears hat out anywhere. I was going to throw that on for you. Bear markets. So it's a time to think about selling some of those rips on these moves because you can take advantage of them. We're seeing that volatility come out. So when the market's ripping higher, we're seeing some of that volatility come out. So even if we're directionally wrong, we're getting helped out by that volatility coming out of it. And if we're directionally wrong, we get that move and it works out for us. So NASDAQ up 250 points on the day. Again, very messy charts as the volatility continues. We're trying to work through this. The bulls and the bears are just battling it out, and the bears are winning right now. E-mini S&P is up 61 points on the day after yesterday's sell-off into the close. That's what we're starting to see a lot of, is some heavy selling coming in at the end of the day. So let's take a look at the SPY. I don't know why I don't have my daily chart of the E-mini S&Ps, but you can see here, this is the SPY, and I put on a couple of trades in here for this short duration, sell into that rip and buy it back when it gets that dip. So I'm looking at the SPY and the March that is expiring on Friday. They are monthlies, but there's only 3 days left on those. So I'm getting that massive theta decay on any given, every single day. I'm getting like 50 cents or something like that in theta decay. I'll have to check that out. Let me just double check that because I said it. I want to make sure that I'm getting that correctly on the theta decay. It's theta decay on these, I'm getting, 60, 70 cents a day on the theta decay. But because it's a spread, obviously the sell and the buy is going to be offset a little bit. So a total of about 20 cents on the spread from theta decay. But the volatility, if we're talking about that, 12 cents for 1 percentage point move in volatility. And when we're talking about it going from something like, 80, which is what we were staring at earlier this morning when I was looking at this, you talk about from 80 to 75, which is just call that the low, 80 to 70, so 10 percentage points. Well, Vega is trading around 13 cents per 1 percentage point. So that's about $1.30 that can come out of those premiums just on that little bit of move in volatility, okay? So that's what I'm looking to take advantage of as well. On this, sell the rip, buy the dip type of trade for a short duration, just trade. I went in and sold those March, sold the 262 calls in there, and then bought the 257 calls in there. You find that risk in there. You can see I got tested a little bit on those. on that rip. Sorry, I sold the 257 calls in there and bought the 262 calls. So yes, I did say that all right, I believe. So defined risk is at the 262. Got tested on those 157s, which put it right there at that point of control with a couple of days left. I thought that was good strike location. Obviously, I got in a little bit early. I started selling when we got above the 200-day moving average, which coincided with the E-mini S&Ps. I'm looking at the E-mini S&Ps to enter the trade because it, to me, has a little bit better chart analysis, if you will. So I sold it when we started ripping through that and testing this value area high. So those are a couple of things we're going to be looking at. You could sell into the 50-day moving average, or the real proper way for the point of control kind of guys, or the guys that are looking at market profile, is sell at the previous day's value area high, which is what I did. If you have a lot less risk tolerance, you could easily look at the 200-day simple moving average to try and do this, but you can see that it very rarely has that trade. So I was looking for something that I was able to get in on with this trade. So I was able to do that collection, selling those 257s, buying the 262s for a total of $1.90. So that fits my rule. My rule is 33% the width of the strike, or a third the width of the strike. As a matter of fact, while I was doing the webinar, it spiked up into the 220s, which is when I tried to do it. But by the time I got done with it, it was back down to around 190. So enter that trade. As you can see, sell the rip, buy the dip. I'm not quite back to that, but market, I think, is going to continue to show some weakness throughout the day as volumes start to lighten up a little bit here. All right, that's all I got for you guys. Please take a moment to go over the disclaimer. Remember, we are an educational company. I am not trying to get you guys to limbing off the cliff with me. Do not take, I'm just talking about my trades because it fits my risk parameters and my market assumption. It's up to you guys to take what I teach you in these daily market commentaries and webinars to implement these strategies in your own way, because you know your risk parameters. If you like spreads and not the naked strategies, then you need to know if that is appropriate for you, okay? So please go over this, and that's all I got for you guys, other than if you can't take that, take it easy.